Africa's largest mobile operator, the MTN Group, has reported that its first half earnings have surged by over 46% for the interim. The mobile operator posted core profit of about 43 billion rand, up 15% from the prior period. Group subscribers rose to 281 million despite SIM registration regulations in Nigeria that restricted outgoing voice services for 19 million subscribers. The operator also took a hit in South Africa from load shedding as network availability was affected. I caught up with MTN Group CEO Mupita earlier today and also asked him about MTN's proposed takeover of Telkom. But since our conversation, another local telecoms company has announced that it is also interested in a takeover of a Telkom. High-speed network operator Rain has since proposed that Telkom merge with it rather than MTN. Here's how that interview went.
We have been investing in our networks for some time, and that investment in our networks has given us the underpin to good service revenue growth. We grew service revenue in line with our medium-term guidance. We were able to eke out EBITDA margin expansion and profit growth in a very challenged macroeconomic environment of heightened inflation, as well as challenging energy and power costs. So, I mean, for us, the highlights really have been the sustained level of investment. We put 17 billion of capex across our network, particularly accelerated network rollout for 4G networks in Ghana and Nigeria. And also, you know, we did have good cash repatriation to the group, which also helped reduce the leverage in our business. And finally, from our perspective, we saw good progress in reducing the cost to communicate. The cost to communicate, if you look at effective rate, per gigabyte of data, that's down 22.5%, and we've expanded rural broadband coverage to almost 86%, in line with our goal of getting to 90% by 2024. So good progress all around in a challenging macro.
Load shedding has come up as one of the most biggest challenges in the past year. But this particular time, you have also said that if there is as much load shedding in the second half of the year, you are advising shareholders that they should expect lower service revenue.
No, that's correct. I mean, we've had unprecedented level of load shedding in the first half of this year, and I think the period between May and June, where we had stage 2, stage 4, stage 6 load shedding, that reduced network availability at some point in June to 89%. We built a world-class network in South Africa over a quarter of a century, where we expect network availability to be around 99%. But, not all our sites had battery backup power as well as gensets. So we've had to actually deploy those on an urgent basis within the capex envelope that we have to try and restore network availabilities into the high 90s. So yes, for sure, it's actually constrained. So we've taken a view that if we see similar load shedding or load reduction in the second half of the year, obviously, the network is not available. You can't create revenue-generating activity. And hence, we're cautioning our investors that if we see similar levels of load shedding, our service revenue will be below our guidance range, but we'll be able to continue to meet our EBITDA margin range of 39 to 42%.
Another set of good results, talking to the investments that you've made when it comes to Fintech in the past 6 months. Even though in some of the regions you operate, there are new taxis for Fintech operations. Talk to us about that part.
Yeah, we remain encouraged with the growth of the Fintech ecosystem. I mean, we look at transaction activity as an indicator of the health of customers demanding and using these fintech services. So that transaction volume is up 31.5% in the period. That activity has not translated fully into service revenue growth. Service revenue growth was about 14%. And it was impacted by two factors. One is the taxes, which have come into markets like Ghana, Benin, and Cameroon. The second is our own proactive decision to cut P2P pricing to stimulate more usage of fintech services. So that's a deliberate plan as we transition our portfolio of services from what we call basic service, such as P2P and withdrawal, to more advanced services such as payments, e-commerce, and bank tech services, which are growing off a low base very healthily.
How is the pace of the decision to actually divest from the Middle East going, since you have also announced that you've received an offer for the Afghan operations?
Yes, as we communicated, pretty much several years back, that we're looking to focus much more on a Pan-African portfolio or set of businesses, and over time, orderly exit the Middle East. Afghanistan is the last of the previously consolidated subsidiaries in the Middle East that we operated in. We're out of Syria, we're out of Yemen, and Afghanistan is the last of the consolidated subsidiaries. We do have a financial investment in Iransal. We have a 49% stake, and that we're going to continue with as a financial investment, for the group. But Afghanistan, we've received a binding offer of $35 million gross, and we're going through the process of looking to close that transaction. And at the time that we've concluded, for sure, we'll share with investors and stakeholders more broadly.
I wanted to tie you down and ask you about MTN's reported offer to the Telkom Group. I saw that Fitch Solutions has actually commented, saying that the offer as it is right now is not going to pass the muster of competition authorities.
We're obviously trading under cautionary, so there's a very limited I can say about the Telkom offer. But what I can comment on is the global trends that we're seeing in the space. I think the first is that you're seeing fixed mobile convergence as networks move through 3G and 4G to 5G. Fixed and wireless assets are going to be required to have world-class networks going forward. So that's the first observation that we see. And we're seeing it, in Europe. You're seeing transactions of that nature happening in a market like Spain. You're seeing it in Southeast Asia, in Malaysia specifically. And, even in South America, you have that move towards fixed mobile convergence. The second is, in emerging markets in particular, the capital investment has got a large dollar component, but you're earning your revenues in local currencies. So without scale, it's almost impossible to invest sufficiently in the network. And what we're seeing is in-market consolidation in the U.S. The U.S. with 300 million plus population has only three operators, but they're well invested, they have spectral assets, and they're able to provide very good services for their communities. And you are seeing in-market consolidation across the market. So the thesis, and this is a thesis that we have communicated for some time as MTN, is that over the medium term you will see in-market consolidation. We are seeing number 2 and number 3 combinations coming through. So that's more the kind of backdrop and context. But the specifics of the discussion we started with Telkom, I can't comment on that as we're trading under cautionary, and we are constructively engaging with them, and let's see what happens.